If you think governments control the global money supply, you're already one step behind. If you think it's central banks, you're closer, but still wrong. Because most of the money moving through the global economy isn't printed by governments, and it isn't created by central banks either. It's created by banks, quietly, repeatedly, every single day. And once you see how it actually works, you can't unsee it. Right now, global debt is over $300 trillion. That's more than 3 times the size of the entire world's economy. Every dollar of that debt is also someone else's asset, someone else's income stream, someone else's leverage. And almost all of it began the same way, with a loan. So let's slow this down. When people imagine money creation, they picture a government printing press, or maybe a central banker tapping a keyboard. That's the public story. It's neat, it's clean, it's mostly incomplete. Here's what actually happens. You walk into a bank and borrow $10,000. The bank does not go into a vault and pull out someone else's savings. It does not transfer pre-existing money from a big pile. Instead, the bank creates a deposit in your name, out of thin air. On its balance sheet, it records two things at the same time: an asset, your loan, and a liability, your deposit. Money appears the moment the loan is issued. No printing press, no taxpayer funds, no gold bars moving around, just accounting entries. And here's the part that feels slightly absurd. In modern economies, this process creates the vast majority of money in circulation. In the United States, in Europe, in the UK, over 90% of broad money is bank-created deposits, not physical cash, not central bank notes, digital bank money. So who controls the money supply? The institutions that decide who gets loans, which means they decide who gets to expand, who gets to buy assets, who gets to scale a business, who gets to survive a downturn. Money is created where credit flows, and credit flows where incentives point. Now let's zoom out. Central banks like the Federal Reserve do matter immensely. They control the base layer, interest rates, reserve requirements, and liquidity in the banking system. They set the price of money. They act as lender of last resort. They can inject reserves during crises. But they do not directly control how many loans commercial banks issue. They influence, they nudge, they incentivize. Banks decide. And banks are not neutral public utilities. They are profit-seeking institutions, which means money creation is tied to profitability. That sounds obvious, but follow it to its conclusion. Banks prefer lending where collateral is strong and risk is low. Real estate, financial assets, government-backed borrowers. Not early-stage manufacturing, not uncertain innovation, not small, unstable businesses. So when central banks cut interest rates to stimulate the economy, banks often channel that cheaper credit into asset markets. Housing prices rise, stock valuations expand, asset owners get richer. Meanwhile, wages don't move nearly as fast. And the public narrative says the economy is booming. But what's actually booming? Asset prices, fueled by credit expansion. Here's the uncomfortable math. If most money is created through debt, then money expansion requires rising debt. When debt grows, money grows. When lending slows, money growth slows. When credit contracts, money disappears. Yes, disappears. When a loan is repaid, the deposit that was originally created is erased. The money is extinguished. Creation and destruction, expansion and contraction. The money supply breathes through credit cycles. This is why financial crises are so violent. When banks pull back lending, the money supply tightens. Businesses lose access to credit. Asset prices fall. Collateral weakens. Banks lend even less. A feedback loop. In 2008, this loop nearly froze the global financial system, not because there wasn't paper currency, but because interbank trust collapsed. Credit creation stalled. That's when central banks stepped in aggressively. Quantitative easing, emergency lending, massive balance sheet expansion. And here's the twist. Even when central banks created trillions in reserves, broad money didn't surge automatically, because reserves are not the same as bank deposits circulating in the real economy. Banks still had to lend. Which brings us to the power dynamic. Central banks set the conditions. Governments borrow and spend, but commercial banks decide how far the credit machine runs. They are the gatekeepers of money creation, and their decisions are shaped by capital requirements, risk models, shareholder returns, and regulatory frameworks, not by public votes. Now layer in the global dimension. Large multinational banks operate across borders. Dollar funding flows through London, Singapore, New York. Offshore markets create dollar liabilities outside the United States. The euro-dollar system, essentially dollar-denominated banking outside U.S. jurisdiction, has for decades expanded global dollar liquidity without direct control from the Federal Reserve. That means global money supply is influenced by institutions that operate in legal gray zones, responding to global demand for dollars in trade and finance. It's not a single command center, it's a network, a decentralized, profit-driven web of balance sheets connected through leverage. Public debate often focuses on government spending, deficits, and money printing, but the larger force is private credit expansion. In most advanced economies, government deficits add to debt gradually. Private credit cycles swing violently. Housing bubbles, corporate debt booms, leveraged buyouts, speculative manias. When optimism rises, banks expand credit. When fear spreads, they retreat. And because money is credit, the economy expands and contracts with their confidence. Here's the irony. We talk about the money supply as if it's a fixed quantity, like water in a tank. It's not a tank. It's a series of promises. Promises to repay. Promises backed by assets. Promises that can be created faster than income grows. And as long as borrowers can service those promises, the system appears stable. But if income growth slows while debt continues rising, something has to give. Either defaults rise, or central banks intervene, or inflation erodes the real value of debt. Sometimes all three. So who actually controls the global money supply? Not a secret cabal, not a single government, not even one central bank. It's controlled by the collective lending decisions of profit-driven banks, shaped by regulation, influenced by central bank policy, and fueled by borrower demand. A distributed power structure. And that makes it harder to see, because there's no single villain, no dramatic lever being pulled in a hidden room, just incentives. And incentives, quietly, scale. The long-term implication is subtle but profound. If money creation is tied to debt, and debt requires perpetual growth to remain stable, then the global economy is structurally dependent on expansion. Growth isn't just desirable, it's required to keep the balance sheets balanced. Which raises a final, uncomfortable question. If the people who create most of the money are incentivized to lend more during optimism and less during fear, and if the system requires ever-expanding debt to function smoothly, what happens in a world where growth structurally slows? Who controls the money supply then? And what happens if they decide not to expand it?